equity returns in the second quarter of 2020 were driven by the massive liquidity that was injected into the financial system by the Federal Reserve in the first quarter and in the second quarter. And it's also been driven by the yield advantage that the stock market has over the bond market and other markets. So the yield on the stock market exceeds 2%, the free cash flow yield on the market exceeds 4%, and the return that you can get on 10-year treasuries is only 0.75%. And that spread makes equities a lot more attractive to invest in than the bond market. The other thing that's been driving the market is positive news on COVID. So we had a couple of drugs that seem to help with dealing with the symptoms. So remdesivir from Gilead. And then we also have some really positive news on vaccines, although those probably won't come to the market for another year. As always, when you have a roaring up market, appreciation performance relative to the market is going to be challenged. And the second quarter of 2020 was the most powerful quarter in 22 years. So going all the way back to the fourth quarter of 1998. The reason that we lag in that situation is that we're a conservative fund. We own companies that are bulletproof in a downturn, but they do have a tendency to lag a little bit on the upturn. That said, we were up more than 19% in the quarter, which is a very big return. The biggest returns in the portfolio came from those big tech companies like Microsoft and Adobe, which are big beneficiaries from the cloud and actually from COVID, because COVID has demonstrated that their business model and maybe even advantage their business model for now and going forward. Now, standout areas where we were hurt were in the banks, and that's because the market has discovered that with COVID, or believes with COVID, that interest rates are likely to be extremely low, close to zero for a long period of time. And that's a significant pressure on bank earnings, not just for the short term, but for the long term, because it pressures net interest margin. We hit a peak in new cases of COVID in the United States yesterday, and seem to be, at least for the near future, that's going to continue. The critical question for that is going to be, can we get it under control during the summer? Because it's going to be very hard for the economy to really reopen in the fall if school kids can't go back to school, because there's so many parents who need to be home to look after their kids. They won't be able to go back to work. So watching COVID is a critical factor. So in that environment of uncertainty, we have a portfolio that's got a barbell. On the one hand, it's got a lot of those big tech companies and growth companies that do well in the COVID environment. They're companies that benefit from very strong online sales and working from home. On the other hand, when we see the opportunity, and I emphasize only when we see the opportunity, we will not chase stocks. It's just not what we do. But if the market gives us a chance, if it comes in, then we will add to those positions that we have in more cyclical companies that will benefit from what happens after COVID. So we're looking for companies like that. The home builders had quite a run, and because people are starting to move out of the cities again and move back into the suburbs, and we're actually seeing up numbers year over year for home building sales. Now, again, with the resurgence in COVID, that'll probably come off a little bit, and the stocks may take a little bit of gas, but there's some really good quality companies with good balance sheets and a clear demand picture out there. Companies like Toll Brothers and Lennar, that if they come in 10, 15, 20%, would be a great opportunity for us to buy.